Hello everyone and welcome to our channel. Today my guest, a good friend of mine and a colleague, Mesh Mystery, is here to talk about a couple of things that everybody has been talking about today. Inflation, deflation, and the current market situation.
Yikes, Ellis, so awesome to be back here. Good to see you again.
Thank you so much,
Yeah,
man.
for sure.
Looking sharp, looking sharp.
I gotta keep up with you, man. Gotta keep up with you.
Well, thank you for your time. I know you have a busy
pleasure.
schedule and stuff like that, but I believe that the viewers need to hear this, and everybody has been talking about inflation, deflation, what that means, and the current situation, and we have seen shifts in market and stuff like that. So, if you could please give us your opinion on it.
Please don't take any of this as personal advice, but this is just my opinion. No, this is actually, I get this conversation all the time from people. And I'll start off by saying what the general understanding of inflation is different to how I explain it to my daughters or anyone else. So most people think inflation is, the cost of goods continues skyrocketing. It's gonna cost me more to buy things. And while that is true to a degree, I like to put it in a different way. It's actually more the erosion or the depletion of your buying power. Now, what does that mean?
Interesting.
Yeah, what does that mean? So basically, if you took $100 January 1st of this year, and at the end of the year, so let's say December 30th, okay?
Right.
The buying power of that same $100, had you just put it in the bank, is now worth $80. So really what's happening as inflation increases the cost of goods, the cost of services, your ability to afford those cost of goods and services diminishes or goes down. Does that make sense?
100%. So the value that you have, the value will remain the same, but the buying power, right? Because that, or
kind of, sort of, but not. So the term inflation, what does that mean? It basically means to inflate. So that's exactly, think of a balloon, right? That's typically what inflation is. So cost of goods have gone up, but your ability to afford those goods have gone down, if you look at it that way, right? So said in maybe a different way, what people don't understand is, the cost of goods will go up, they're not gonna come back down. The cost of services go up, but does your rate at which you earn money go up the same? It doesn't.
Probably not.
It doesn't.
For most people.
Most people are on fixed income, so that's
Sure.
the majority of the country, the majority of people out there. They're on fixed income, meaning they have a salary. So that's where people start feeling the pinch because, the cost of their utility, their bills, their living expenses. Food's the best one to say because that's something we can all wrap our head around.
And we see it. I mean, we see
I
it
went to the
day
grocery,
to day.
every time I go to the grocery now for what used to be $20, it's $80 before I leave. Right.
So basically, the $100 bill is same $100 bill, but doesn't have the same value.
You might as well call it a $50 bill. Yeah, right. Exactly. That's exactly the way to look at it.
Okay, got it. Yeah.
Does that make sense?
100%. So putting it in in a graph.
This is a great one. A cup of coffee. Come on.
Right, a cup of coffee. Everybody.
Now it's a $30 cup of coffee.
Exactly.
Right?
Depends where you go, but this is basically putting it into simple terms.
This is great. Yeah.
Like I remember the 2000s, right? I paid $1 for coffee. Most of us did at our local, Timmy's or Tim Hortons or whatever the case might be. So basically, this is what's going on. Why is this happening? Because of inflation rates, different aspects of logistics and oil maybe, or
so basically, like we said, what this really means is it's not so much that yes, the actual dollar amount has gone up. So you can say, the cost of goods has gone up. Another way to look at it is the actual buying power of the dollar is depleted so much. So let's say this is the same dollar for 1970 that it is in 2022.
Okay.
The power of the dollar in 1970 was significantly stronger. Significantly stronger. And that ties into the price of homes and it ties into the price of all assets, ties into everything. So you needed less money to be able to afford the same things. Fast forward to where we are now, and now what it is, you need a lot more money to afford the exact same thing. It's not like you're getting more for it.
Right.
You get the exact, a cup of coffee is a cup of coffee. You would argue that maybe it was better back then, but it's the same. You can get a good cup of
same
coffee
product,
now.
I would say.
You're not getting any more, but it's costing you more because your dollar's worth less.
So if I would translate it into real estate, right? Like in the 70s, I mean, you've been around like for a long time. You've seen the shifts in the market, you've seen up and downs and all that stuff, right? You've been around for a while, but in the 70s, for argument's sake, houses would cost what? 15,000, 20,000?
Yeah, let's just throw an easy number. Let's say 20,000 for an easy number.
$20,000 for argument's sake.
Give or take.
Great.
Yeah.
So that same home, is it still worth 20,000?
No,
it's not, right?
No,
like it's
no, but like, so when we talk about inflation and the consumer price index, which we won't really touch on, but that's what all the goods and everything is based on, that $20,000 house, if you were to buy back then, let's just say, and I'm spitballing, so don't quote me on this, you can look up the numbers, but let's say the average income or the base income, the minimum wage was $1. Let's just say.
Got it.
Might have been $2, might have been 50 cents, but I'm just going to say it's $1. Okay. How this translates and works out is, even though it was $1 and your house was $20,000, the power of that dollar is equivalent to today's $18.
Exactly.
Right? So now people think, oh, minimum wage is $18, whatever, is it $15 or $16?
I don't know. I think it's somewhere like around 17 or something.
I know there was
like
talks of bringing it to 18.
Yeah.
So everybody
18,
thinks on paper, great, $18. But we're still talking minimum wage, the bare minimum to have to be able to live in this country, in this world. If you translate that back to here, the power of 25 cents was greater than $18. So that's the thing to wrap people's head around, right? To be, yes, the number seems good, but if the value of that $18 is less than 25 cents, I would have rather made 25 cents in 1970.
Yeah, I got it.
That's how inflation works. Basically, it erodes your buying power just because there's more money in supply, which means that you need more of it to buy the same goods. Perfect. Supply demand.
So how about this slide?
Deflation. Okay. we're getting into all of this stuff. Eh? Okay. Excellent. So let's read what it says, and then I'll give you kind of my 2 cents.
Sure. So deflation occurs when the inflation rate falls below 0%.
Yes.
Inflation reduces the value of currency over time, but sudden deflation increases it.
Yeah, so that's correct. Basically, deflation is the inverse of inflation, meaning, to put it in simple terms, like if all of a sudden tomorrow output decreased and we had a fixed amount of resources, meaning your currency all of a sudden started to deflate, okay, that means that the what you could buy with that money increases. Okay? So take, for instance, people think, oh, deflationary is great. And in some cases, it is great.
Yeah.
In fact, it's fantastic. So if you're holding hard resources, if you have currencies and it's deflating, meaning there's less of supply, great for you because it's worth a lot more. Okay, it's worth a lot more. But it could also be negative for business owners and whatnot, because now that products are becoming more and more scarce, it's harder for them to produce more to keep up with what's out there. Like it's not the best environment to spear growth and for business and whatnot, because now there's just more money out there, so they're making less and less, right?
I understand. Okay.
Yeah.
Okay. So it could be good. It can be bad. I guess everything is okay if it's moderate, and we see shifts and we don't know where and how this is going to go. But let's try to explain it from this standpoint: manufacturing, employment, and we touched about the dollar in the inflation.
Yeah.
Now the deflation. How can this be translated when it comes to
inflation and deflation?
Well, deflation in this case, right?
So in the case of deflation, what ends up happening is, because if the value of their money is increasing without them necessarily doing anything, there may be a chance for them not to want to spend money in the economy, right? Because if things continue to go down, it's stuck. Like if you know your assets are growing,
right,
without doing anything, then you're like, just like the market we're potentially in, where you're like, hey, let's hold on because the prices are still going to go down.
Right.
Let's wait, things are still going to go down. And what ends up happening is, if everybody's in this position of just holding on because the value of their assets are growing or the value of their currency is growing, what happens to the economy? It's not good for business. It's not good for suppliers because nobody is buying. Exactly.
So is this one of the reasons why we have seen the current real estate market the way it is? Less supply, I would say.
Yeah, so real estate's a great tie into this, and I think we're going to get into some of the other reasons why that is. But yeah, so there's less supply on the market, even though right now we're in the busiest time, say the spring market,
Sure.
so a little bit more has kind of upticked and come on the market.
Yep.
But yeah, so
But on average, it's been less than
less than normal, and that's because we're in an inflationary period of like high interest rates. So the high interest rates come because that's a tool that central banks, the government uses to help stifle off inflation. Now, rewinding the last 2 years, there's been a lot of stimulus that came into the economy because of the pandemic and because we needed to get a lot of stuff done, and a lot of money was pumped and a lot of money was printed.
Printed, exactly.
So that money, like water, needs to find a place to go.
Yeah.
I'd love to say that we were all smart enough to just sit on it, be frugal, but we all spent. We
Right.
all did things because there was nowhere else for us to go.
Right.
So because there was extra money in the system, it needed to find places to go. That's what drove up prices. That's what drove up hard assets. That had people buying, I know you're a watch guy, that
Sure.
had like the global prices of these brands
Oh my
like through the roof.
gosh,
You can't even
through
get a
the
watch
roof.
at any supplier, right? The wait list is impossible to get one. That's because there's all this money that had nowhere to go. So people, you started hearing, I know there was a big crypto boom and NFTs where people were buying absolutely ridiculous things for no reason just because they had the extra money.
100%.
Okay?
100%.
So now what happens is, so the term for that was quantitative easing, meaning they're printing a lot more money in the system.
Mm-hmm.
Now what they've had to do is to slow that down because remember just a year and a bit ago, the market was so rampant, okay? It was so crazy. You couldn't buy anything. And it was actually worse than 2017 because you couldn't buy stuff. People that were buying at like ridiculously overvaluated prices. Now
Inflated,
inflated
right? Like
prices.
crazy, yeah.
Now those same places are not valued at that. So unfortunately for people, they have to ride it out a little bit. So now they turn to tightening measures on, which basically means they're going to start increasing and notching up interest rates, and that's what they've been doing.
Right.
Rate hike after rate hike after rate hike. So that's the current position we're in right now.
So it's perfect for, so look, current situation.
Yeah.
Where are we in this graph?
Yeah.
Inflation, deflation, well, we're not going to get into, stagnation. It's another word.
Yeah, stagflation for sure.
Yeah.
So you're absolutely right. So we're actually, and first of all, nobody knows. I mean, if I had predicted this or you had predicted this, we'd be in a much different place. So I think you got to look at where the government is, where the economy is. It's like a balancing, like a tightrope.
And a lot of things have been happening. Like
Yes.
it's such a our client, like my clients, I'm sure your clients as well.
Yeah.
People are like the changes have been happening so quick,
Yes.
right? And the market shifts and the dynamic in the market.
Yeah.
It can vary from month to month, from week to week.
Yeah.
Never mind,
Yeah.
like back in the day, we had next year it'll be
Yeah.
this or it'll be that.
Yeah.
Now it's getting harder to predict because where are we now? Inflation, deflation, this, that, uncertainties,
Yeah.
maybe another word is fear, and then how to utilize the current, I will say, currency or
Sure.
benefits that you
Sure.
possess or own.
Yeah.
How do you juggle that? You know what I mean?
Yeah, so getting back to, I think, the original point that we talked about, we were talking about kind of what's the current situation, where do we see it going? I think we're almost at the crossroad, okay?
Yes.
Now, I personally think that, could the Bank of Canada or the US Fed, because everything is kind of tied into that,
Sure.
could they still raise interest rates? Yeah, I think there's a chance. There's a good chance. By how much, I don't know. If the inflation numbers still aren't under control, that's the main tool they have at their disposal to be able to slow things down.
So the next one is April 12th,
Yes.
which is in a few days from now.
So this is the thing. The unfortunate part is, depending on what they do, we're in this dangerous territory where if it doesn't rectify and turn the ship the other way, we can move towards stagflation. And that's what we talked about. I won't get too deep into that, but basically that is, we're still in this market where we have an inflation cycle. But now interest rates continue to go up, and it's slowed down everything to the point where the economy comes to a grinding halt. So we have to be careful not to do that, because that'll set us back nobody wants to be in that situation. Let's just put it that way. Yeah, or whatever it is.
But people are saying the last decade or not, or some people are saying last decade.
Yeah.
Some people are saying, well, great opportunity.
Yeah.
So it depends where you are, how the coin will fall for you and your situation.
Yeah, and listen, you talked about real estate. That's, end of the day, that's a space that we know a little bit about, right? And so I can't speak to all areas. I know that we're here, when we're shooting this video, we're in the greater Toronto area. We're realtors in Toronto. And I still think the positive growth in Toronto far outweighs the short-term pain. So I think that at least for the next 5 years, it's positive for us here in Toronto.
A lot of positive
and a lot of other markets too, but I don't want to blanket it with everything, because each geographic area is different, and we got to look at the factors
within the
for
city,
there.
outside the city, suburbs.
But being in this big metropolitan, this big metropolis, I think that for most of us that are investors, homeowners, thinking of getting in the market, there's a lot of reasons why this is still a pretty safe place to hedge your bets. Yeah.
So. This is maybe
a
great solution,
segue. That's
right?
a great segue. Yeah. So that last statement I made was hedging your bet. So what can we do? What can we do in the current climate? It's not all doom and gloom. It can be scary, for some a lot worse than others. But overall, everybody's affected. Everybody's feeling it at the gas pumps if you drive, on the dinner table. Dinner table is the most tangible. Rent and mortgage payments. These are things that we can all, as Canadians and humans, relate to, because that's directly in front of us. Okay, so historically, and nothing has changed, the best hedge against inflation has come in the form of a couple of things. And I see you've put it up here, which is great. Real estate, go figure, is one of the pillars, in my opinion, and I'm not saying this because I'm biased, it's probably the best pillar, because it is a hedge against inflation. And I'll tie them all in at the end. So we got real estate on the one side, which you've put here, which is great. You've also got hard assets such as gold and silver, known as commodities. Okay, so these as well are a good hedge, because limited supply. Once upon a time, everything was backed on the gold standard. So it doesn't move like printed money moves. You've got here oil. So in times of the past, oil has also been a good currency hedge, because people need energy. And until we transition to a full electric, still a ways away, and it's great that that's happening, there's still going to be a demand and use for petroleum products. So that's not going anywhere. And then finally, stocks you've heard of. So stocks, and most recently cryptocurrencies. People have talked about things like digital assets like Bitcoin as a hedge, because it's not governed by any other factors. Okay, and then treasury bills and T-bonds and that type of stuff. But really, these are the main things that you want to use as a hedge. And what does that mean? What does that mean? People say, what's a hedge? So all that really means is, listen, you're not going to stop inflation, but you're going to move with inflation. So if you get into an asset like real estate,
what's the game plan?
Like we've noticed,
you got to have a game plan.
As long as we're getting in there, not necessarily even invest. That's a little bit more advanced, but even as a homeowner, if we're sitting on the sidelines, we've had clients over the years who are like, I'm just going to wait because I'm going to build a little bit more down payment and to wait. But that day never comes, because the cost keeps getting further and further away.
It's hard to catch that.
It's hard to catch it. And the rules keep changing, right? So rather, if you're moving with real estate, meaning as the prices move and adjust, well, guess what? Your wealth is increasing. Because your dollars are moving with inflation.
Another stability, like there's also there's pride in ownership, I would say. And there's also when you are a tenant, there's a lot of uncertainties. The landlord might sell, move in. This and that, right? So when you're a homeowner, a real estate owner of some sort of kind, you can do adjustments. You might be able to rent parts of your real estate. You might be able to increase values to different,
And no time is this more relevant than right now in a hyperinflative environment, because what ends up happening is this: even the prices of rent are extremely high.
That's what we signed.
Extremely high. In a market where we're balanced, the argument could be made that, hey, you know what? Renting is just as good. And I believe that in big market cities, it's great. If you have investments, sometimes the model is, listen, you rent where you want to be and you invest elsewhere because the returns are better. And I believe in that. But right now, you said it best. What happens if tomorrow, your landlord sells a property, or what happens tomorrow?
It's a headache,
rates
man.
are X, and
a headache.
at least if your money's moving with real estate, then when you eventually do go to sell, you've got higher than the current market value for your asset or
Yes.
investment. Does that make sense?
100%.
Yeah.
So going into silver and gold and all of that stuff, that could be bought in different ways.
Sure.
That asset,
Sure.
let's call it that,
Yeah.
can be bought in different ways.
Sure.
Gold bricks, silver coins.
You can even
Buy
buy
small,
shares to the
just
bank.
shares to the
Exactly. You
bank.
can have a note that's whatever. I physically am a proponent. I know it sounds crazy, old school.
Yeah.
I love the idea of having a brick.
Yeah.
We put on the goggles, smelt some
Yeah.
of it. I've been watching too many movies, so
I
maybe
know.
that's not realistic. But it transfers from generation to generation. That's why it's always been.
No, but this has this type of an asset increased. I mean, the people are buying it, right?
Yeah.
Like silver coins, small coins, big
Yes.
coins.
Yes.
Who knows what people are thinking on the streets,
Yeah.
but people like to have it.
Yeah.
Because it proved historically that it keeps value,
Yeah.
right? Like
Yeah.
it's like simply put, like when you get into these things, like we don't know, like stocks, like obviously we're not giving any advice to any of you there. Like you have to do your own due diligence, right?
Gotta,
I mean, like
you got to do your own research, and also this is more educational than anything. We're not advocating that this is the way you should go by any stretch of the man. Find a professional in the space, someone that you can trust as a financial advisor or registered stock trader who can give you, years and years of information. Same with this commodities, someone that's in precious metals that gets it. Don't talk to cousin Joe, even though he's really good. You know what I mean? You want to understand really where it's coming from. Commodities, once again, like I'm not a commodities trader, but you can do enough research to find people that are good in the space. And real estate, I think you and I can help with that a little bit. We know a little bit about that, so just warrants a bigger conversation, right?
So I heard something. I heard something this morning, and it was interesting. A colleague, a friend of ours. I'll do a video with him soon.
Yeah.
And he said something to his clients. I possess the current heartbeat and the information right now, right here. Because by the time it gets to the TV or it gets to your convenience store, neighbor guy or whatever, right? It's already 2 weeks old, 1 month old, 3 months old, whatever.
Sure.
Because they're looking at data.
Sure.
Once the data has been, like we lived through the last month and last 3 months, frontline right now, the pulse of the market and what's going on. Would you agree with that?
Yeah, for
At least when it comes to real estate, right? Because
Well, I mean, so what people don't get is we're both full-time agents. And not only are we doing this to service our clients, we're investors, we're property owners, we've owned property. So we make a living doing this, right? There's a difference. And I'm not taking anything away from, just like I've dabbled in stocks, I'm not a stock trader. In fact, don't come to me for stock ideas, right? Crypto, I got my head around, but like a lot of people, I still think the long-term position of it could be interesting, but it's going through its challenging phase right now. So I wouldn't give advice on that either. I've just been doing real estate long enough where, I can tell you what I've seen through a few cycles. You can tell you what they've seen.
Absolutely.
And it's what's kept me in the business. It's what's kept me through these last 2-3 downturns. It's what's, put the roof over our head.
You know what I mean?
It's what keeps my kids going to school. So in that context, because we're full-time, full contact at it, I think we can lend some credibility to that space because we're not doing it as a side thing. We're doing it full time.
Absolutely. Yeah. And then we saw it, like a month ago or 2 months ago, we could predict the bidding wars and the market and all of that stuff. We saw it. And then they came out, there's like, there's bidding wars. They were a month late.
Yeah.
Some of my clients used the opportunity to get great deals out there, right? But it was a good point brought to the table that
Sure.
that I really appreciated.
Sure.
So I think I want to stop it here. Like there was some great value, I believe, for all of us.
Okay, good. I'm glad.
And I want to thank you for coming.
Oh,
and
always.
It's always great video, and I always like to watch it.
Oh,
so
brother, thank you.
Thank you so much,
Hey.
and see you again.
Thanks, brother.
Thank you.
Thank you.